$100 billion erased. Not by war, not by bankruptcy court, not by a global financial crisis, but by a single document uploaded to the internet. Gautam Adani was the third richest man on earth. His empire controlled ports, airports, power infrastructure, logistics networks, and massive industrial projects across India and beyond. On paper, it represented scale, expansion, and political influence combined with aggressive growth. Then a small research firm in New York pressed publish. Within hours, the report spread across global financial markets. Within 48 hours, panic followed. Stocks collapsed, bonds dropped sharply, international investors pulled capital, billions in market value disappeared almost instantly. If you want to understand how power moves behind financial headlines, subscribe now. We break down the strategies, incentives, and power structures behind market collapses and billionaire battles. Now let's understand how this happened. The firm behind that report is called Hindenburg Research. Hindenburg does not build companies. It does not manufacture products. It does not run funds or operate like traditional investment institutions. Its business model is built around investigative research combined with short selling. Short selling means betting that a stock will fall. Here's how it works. You borrow shares and sell them at today's price. If the stock drops after your report creates pressure, you buy the shares back cheaper and return them. The difference becomes profit. The bigger the decline, the larger the gain. Hindenburg publishes detailed reports accusing companies of accounting manipulation, misleading financial disclosures, inflated revenue reporting, hidden liabilities, or valuation practices that do not match operational reality. If investors believe the allegations, they sell. Selling creates more selling. That reaction amplifies price declines beyond the original trigger. Financial markets are not purely rational systems, they are confidence systems. Stock prices move not only on earnings, but on belief in future growth. When Hindenburg releases a report, it does not need instant legal proof to create impact. It only needs to introduce doubt, because doubt spreads faster than facts. Regulatory investigations take time. Courts move slowly. Accountability unfolds over months or years. Markets react instantly. Once confidence cracks, liquidity follows. Once liquidity disappears, valuations fall quickly. Before targeting Adani, Hindenburg used the same approach on other companies. One major example was Nikola. Nikola was once valued as a breakthrough electric truck company. Investors compared it to established automotive giants. Its founder was portrayed as a visionary challenging legacy industries. Valuations surged as hype expanded around production promises and technological disruption. Then Hindenburg released a report questioning its technology claims and operational transparency. They exposed promotional footage showing a truck appearing to drive under its own power, when in reality it was rolling downhill without propulsion. After the report, scrutiny intensified. The stock collapsed. The company faced regulatory investigations. Its founder eventually confronted legal consequences. That case strengthened Hindenburg's reputation as a firm capable of moving markets through research exposure. And the pattern continued. Companies like Clover Health, Lordstown Motors, and Block also became targets of detailed investigations and short positions. The structure behind each case follows a consistent system. Identify overvaluation. Investigate inconsistencies between claims and reality. Publish findings publicly. Take a short position before release. Profit if market confidence declines. Supporters argue that short sellers act as financial watchdogs. They expose fraud that regulators sometimes detect too late. They challenge exaggerated growth narratives. They force transparency by revealing hidden financial risk. In that sense, they act as a counterbalance to unchecked optimism. Critics argue short sellers benefit from fear and volatility. If panic spreads beyond the evidence presented, damage multiplies. Companies may suffer severe reputational harm even if allegations are later disputed or partially disproven. Ordinary investors often absorb losses during rapid sell-offs, while sophisticated short positions profit from downward momentum. In a zero-sum financial environment, one participant's gain often mirrors another participant's loss. Hindenburg operates directly inside that tension. Their power does not come from size. They are small compared to the corporations they investigate. Their power comes from leverage. A single detailed report can move billions because modern markets react instantly to information. Once published, reports spread globally within minutes. Social media amplifies them. Financial platforms broadcast them. Trading algorithms detect volatility and adjust exposure automatically. Speed transforms research into market movement. That speed is the force behind the Hindenburg effect. It shows how fragile financial confidence becomes under public scrutiny. The original Hindenburg airship failed because it was structurally vulnerable under pressure. Financial empires fail in similar ways. The larger the valuation and the stronger the public narrative, the more confidence is required to sustain it. Hindenburg Research does not create weakness. It exposes existing weaknesses. When those weaknesses are revealed publicly, market reactions can trigger rapid corrections. In today's financial system, perception is power. Information travels faster than institutions. Narratives shift billions in value. Data has become one of the most powerful tools capable of challenging economic dominance.